We haven't forgotten that on Friday we got that big rating upgrade from Moody's. Still a lot of debate on, whether this was a backward-looking upgrade where the rating agency is sort of taking note of some of the reforms but also readjusting the way it looks at India's debt dynamics, or if this is forward-looking and Moody's is convinced that all these reforms are really going to change the structure of the Indian economy. Sajjid Chinoy, Chief India Economist at JP Morgan, is joining us here. Sajjid, good morning. Thanks so much for taking the time to speak to us. How did you see this, Sajjid? Backward-looking, they're accepting their mistakes, that India's debt to GDP should be seen differently, India's per capita GDP should not be seen as a constraint on rating, or did you actually believe or go with their view that all these reforms are going to change the structure of the economy?
I take a more minimalist view, which is the fact that 2 years ago, Moody's did upgrade India's outlook to positive. Now, once a ratings agency does that, within the next 2 years, you have to make an assessment of either to go to the next level or to go back to a stable outlook. And I think nobody who objectively looked at what's happened in the last 2-3 years would have agreed that, the outlook should be reduced to stable, because you've had a number of institutional reforms, all of which will take a long time to have an impact on the economy. But I think what was most important is if you look at their criteria, economic strength, we do very well. Institutional strength, we're moving up. On the fiscal dynamics, we're still weak. But I think the part that kind of was the tipping point was Moody's now believes that India's ability to handle event shocks has gone up. And there I do agree with them. The fact that we have a monetary policy framework means inflation will never be running at 8 or 10% for years on end. They're really hopeful we get the FRBM review, FRBM recommendations on a fiscal anchor. I think they're happy that fuel prices have been deregulated. So if oil prices go up, those are passed on and there's a demand response. So I think ultimately two points I make. One is there is a greater belief now that some of the institutional changes in the last 3 years have better prepared India to handle external shocks and event risks, and that gives them more comfort that debt to GDP will not go up. It will come down slowly but not go up. And secondly, I think why now? I think it was the PSU bank recapitalization, to be honest. In their last assessment in August, they had said that a key ratings drag was risks in the banking sector, and I think once the government committed some capital, I think that was kind of the last uncertainty that was cleared away. So I think it's less relevant whether it's backward looking or forward looking. It's more a confirmation that we now have a set of institutional changes that make the Indian economy a little more resilient to shocks, whether domestic or external.
Okay, so that's a view you're taking on it. But they've listed out a whole host of reforms, Sajjid. Not all of them sort of go into that narrative. I mean, they're talking about, say, GST, Aadhaar, demonetization. I'm not sure why they put that in as a reform. But they just seem to sort of lump everything together and say that, we're finding a reason to do this right now. But maybe that's what you're saying, that they had to move because they had a positive outlook.
Yes, and also I think ratings also tend to be a little more sluggish. I think like monetary policy, ratings agencies don't want to upgrade you one day and then 3 months later be forced to downgrade you. So they do tend to take a much more strategic view on things rather than a tactical view. I mean, one could be very critical and say, fiscal risks have gone up in the next 3 or 4 months. We don't know whether this year's fiscal deficit target will be met. State finances at the margin have gotten worse. As a consequence, in their own estimate, debt to GDP is flat for a couple of years. Oil prices have moved up $10 a barrel. That constitutes a negative terms of trade shock. Why now? But again, I will give them the benefit of the doubt because those are much more tactical issues. Those are 3-6 month issues. I think what the rating signifies or tries to convey is a much more strategic outlook that, 5 years from now, we have a much greater conviction that India's debt to GDP will gradually be coming down. And I think a lot of this is predicated on growth. I think that's the key here, that they expect India's potential growth to go up in the 3, 4, 5 years, so that even if fiscal deficits don't improve by as much as they want, debt to GDP comes down because of the denominator. So yes, they are making, they are being forward-looking and saying all of these things eventually will show up in higher growth. We'll wait and see to what extent. I think next year's growth forecast is a bit ambitious. I think they expect 7.5% growth next year, which will take some doing. But again, I think they're taking a much more 3 to 5 year view, and they tend to move more sluggishly. So I will give them still the benefit of the doubt.
On that debt to GDP point, Sajjid, so you're convinced as well that we will start to steadily come down? I mean, I assume that if we accept the NK Singh committee report, we will have no option but to bring down debt to GDP towards 60%, but I think there's a long road until 2023 or something. We can understand it's stabilizing, but for it to come down means much higher growth, right?
You're exactly right. So I think that will take some time. I'm not convinced that debt to GDP in the next couple of years is going to come down rapidly, even if you don't count the PSU bank recapitalization, because ultimately, if you think of what's happening, the denominator is the difference is R minus G, the difference between interest rates and nominal GDP growth. Now, a few years ago when we had a lot of financial repression and real interest rates were negative and sharply negative, you had this perversity where fiscal deficits are rising very sharply, and yet debt to GDP was coming down because nominal GDP was running at 15 or 16% and real interest rates were so negative. That's gone away by choice, and that's one of the key positives in macro stability, that now the central bank will ensure that policy rates remain positive, which means by construction R minus G comes down. What that means is the numerator has to start doing more work. It means the primary deficit has to start going down sooner. I have no issues with the center. The center has been chipping away at the primary deficit. My concern really is with the states, that if you look at the trajectory of state finances in the last 3-4 years, those deficits have widened, and because there is no market feedback here, borrowing costs for states are really not a function of what their debt levels are or their deficit levels are. There is no incentive for states to improve. So that is a concern for me, which is all the more reason that the center needs to stick to its path and perhaps overachieve in the next 3 or 4 years to compensate for the state. So I do think the fiscal is still a bit of a concern, and therefore what Moodys is banking on is, well, nominal GDP grows up enough that debt to GDP slowly comes down.
Sajjid, on the growth front, again, potential output, potential growth is been debated. The assumption was it has come down over the last few years. What is your own understanding of, I don't even know how soon, or, factors that will push up potential growth rates for India?
Our sense is potential has come down a little bit, but not because of domestic reasons. I think, some of the domestic reforms clearly will push potential growth up. I think, to the extent that the GST, there's so much focus on the GST revenues, but really over the next 3 years, the fact that we now have a common market for GST means total factor productivity, allocative efficiency, where investment is set up, transportation costs, all these things come down. That pushes up total factor productivity. I think if we can recapitalize public sector banks and reform them, more importantly, that will improve credit allocation. So, I do believe domestic reforms are helping. The reason why potential has come down in India is the same reason why it's come down in all emerging markets. It's the fact that we will not get the export tailwind that we did in the mid-2000s. At that time, when India's growth was 9% for 5 years, it was because exports were growing at 18% a year in those 5 years, and that pushed up a potential growth in all emerging markets. The last 5 years, exports have come down to 3% a year export growth rate. So that itself will drag down potential growth by more than 100 basis points. So I think domestic factors do push potential up, global factors push it down. Ultimately, we'll need to find some new sources of growth at home in the next 3 to 5 years to compensate for the drag that exports in the global economy will be on India.
Sajjid, good morning. Neeraj here. If anything, if you hear the chatter over the last couple of weeks by global houses, including yours, I presume as well, the view on calendar year 18 global growth rates is much more lenient. Most people believe that if 2017 was a good year, 2018 could be better. You don't presume manufacturing exports or exports of any other nature would only stand to benefit in 2018 if indeed the global GDP is on its way up?
Well, I'll question the premise that 2018 will be better than 2017. For what it's worth, our growth forecasts are lower next year. for a variety of reasons. If you just go region by region, China's growth clearly peaked in the first half of this year. We're seeing a meaningful slowdown in the second half, and we think that's really, if you look at the language of Xi Jinping at the People's Congress, it was very much now that event is over, focusing on the quality of growth rather than the quantity. We take that as being a sign that China would rather focus on lower growth but more balanced growth. More importantly, yes, the US and Europe have been positive surprises this year. But those are cyclical. If you look at the underlying supply side, our view has not changed. We do believe that potential growth in the US is 1.5% or less. Potential growth in Europe is going to be lower, which is why we take the view that you can't be in this Goldilocks situation forever, where growth is going up and interest rate normalization is so slow so as to not serve as a drag. We do think that inflation does pick up in 2018. Central banks will be forced to normalize faster. JP Morgan's own forecast has 5 rate hikes by the Fed between now and next December. We think the ECB will continue tapering. Ultimately, all of that normalization will have an impact on growth. So the combination of Europe and the US gradually asymptoting towards its lower potential, and China's conscious policy slowing, which then has implications for Latin America and Asia, make us believe that while growth will still be will be healthy, it's not going to accelerate further from the 2017 levels. I think the best is almost kind of behind us now.
Okay, Sajjid, since we have you here, slightly near-term question on India as well. We are running towards a new GDP number. We are running towards another policy as well. What's the slightly nearer-term outlook that JP Morgan has on India growth and, of course, on the RBI policy?
I think the view is that growth will begin to inflect. We think the 5.7 was kind of the bottom of the cycle, but I think it's going to be a slow inflection point. So for what it's worth, our own forecast for the November 30th GDP number is in the low 6s, about 6.2 or 6.3. I think the second half you'll see higher growth, but we need to be careful how we interpret that. A lot of that is going to be a favorable base effect from last year. So just because growth heads towards 7%, we shouldn't claim victory on this front. The fact is there are a couple of headwinds for 2018. One is the deleveraging. I think now that the government's committed more capital, more and more companies will be taken into bankruptcy. This is very good for medium-term growth. In the near term, it becomes a headwind. And the second factor, which we're not speaking much about, is oil. We've been shouting from every rooftop for the last 2 years that much of the growth dividend we got in 2014, 15, 16 was oil going from 110 to 40. Now with oil prices mean reverting, back up to over 60, that will be a small adverse terms of trade shock. So we do see growth accelerating. I think exports will be better than last year. I think the impact of GST is going to fade, and that's going to help growth. But you're confronting these reasonably powerful headwinds as well. So for what it's worth, we do end up with growth at about 6.8% for this fiscal year that ends in March. But at least things get better from here on in, so that's a relief. I think on policy, this is very straightforward now for the RBI. Almost every indication would suggest that they remain on an extended pause. Oil prices are back up above $60. There's more confirmation about global growth and therefore global financial conditions normalizing faster next year. Some concerns on near-term fiscal. Current account deficit we know is on course to tripling from last year. All of these kind of risks move in one direction. So we think the RBI will be comfortably on hold for the foreseeable future.
All right, got that, Sajjid. Always a pleasure to speak to you. Thanks so much for making the time to speak with us this morning.